let me note that a quorum is present. All the committee members are here, and remind that everyone that we are streaming via YouTube. First order of business, approval of the minutes. The committee meeting minutes of February 25th, 2026. I'd like to ask for a motion to approve minutes of February 25th, 2026, meeting of the Finance Committee as presented.
So moved.
Do I have a second?
Am I allowed to second?
Yes, you are on the committee.
Second.
All in favor, say aye.
Aye.
Any opposed? Any abstentions? The approval passes. Information, we will now receive we're going to now hear from the Investment Committee report presented by Mr. Blake and Mr. Strickland from Clearstead. So, Mr. Blake.
Great, thank you. Good to see everybody. We've got a number of important things to get through today. Some bad news for the quarter, but better news into the second quarter. So we'll get there. On the following page are the items that David and I will cover. The dashboard, spend a few minutes on capital markets, our views there, compliance, an investment update, and then that fifth item, longer term expectations from markets and how that applies to the investment portfolio. And then the very last thing, a quick review of the investment policy. So on the following page is the oversight dashboard. So key items being captured here that we believe the committee needs to be reviewing and analyzing over the course of the year. So we continue to stick to this structure. And of course, we'll reprioritize if need be. At the next meeting, we'll spend some time digging into the fixed income investments in a little bit more detail, and also reassessing fees across the portfolio. Next, I'll move into the capital markets review. Yeah, so one more slide there, please. Thank you. So a lot has transpired since we were all together last in February. So in January and February, we saw the economy doing fairly well. We saw markets appreciating. And then in March, of course, the conflict with Iran started. And as you might expect, what we saw is markets sold off. Anytime you see uncertainty like that, you're typically going to see markets react. Most parts of the market globally hit correction territory, meaning they fell by more than 10%. The S&P 500 is one of the few areas that didn't quite get that far. But we've seen a pretty, I'll go through results here, but we've seen a pretty dramatic recovery here in the last couple of weeks. Our research team put together what's listed at the bottom of the page, and the context of that was the conflict is still going on, but when you think about there's an unknown future, the way the team was thinking about it is what hasn't changed, and then what has changed as a result of the conflict in Iran. So the things that we were focused on that have not changed was the tailwind from fiscal stimulus that would impact consumers and businesses in 2026. The AI CapEx build out, we think, continues. Corporate earnings look pretty good. They're expected to be better in 26 than they were in 25. And you'll see a table coming up here soon that expectations have actually increased a little bit from the beginning of the year. And that's with Wall Street expectations, even as the war in Iran has taken place. The overall labor market, we're seeing some inconsistencies, but overall unemployment is low, stable. And then lastly, the consumer, from our perspective, looks to be in decent shape. So all those things still hold. What has changed as a result of the conflict, inflation is a little bit higher. So the price of energy is higher. A little concern we have there is some of the stimulus coming to consumers via higher tax refunds is going to get eaten up from higher gas prices. So that's something to keep an eye on. Also, the market, just based on the shift in the yield curve, has decided that it's unlikely that we're going to get a cut from the Fed in 2026. We're only really looking to get 1 or 2 25 basis point cuts, but it seems like that's probably off the table, at least at this point, and that could change. And then the last thing I'll note that has changed is valuations at least through 3/31 were looking better because markets pulled back and earnings expectations actually improved. So that resulted in better valuations. You can see the market returns there for the quarter and through March, but to give everybody an update for April, this is through today. The S&P is up 9% month to date. The Russell 2000 is up over 11%. International stocks are up 5%, and core bonds are up almost 1% in April. So the results are going to be quite a bit better in the second quarter, at least as where we sit today. On the following page, our updated projections from the Fed, going from the December meeting to the March meeting. So expectations of GDP growth a little bit better, unemployment remaining at 4.4% is the expectation. Inflation, Fed's expecting that to be a little higher by the end of the year. And then the Fed funds rate remaining constant. On slide 7, just going back to that comment I made earlier about earnings expectations getting a little bit better. So at 12/31, we were looking at 15% earnings growth in the S&P 500. It's now 17% is the latest expectation from Wall Street. So that's supportive of capital market growth and valuations that we're seeing today. And then lastly, I think as you all know, a lot of the investments with the system are in fixed income. So just keeping an eye on the yield curve and forward expectations here are important. But what you can see is the yield curve is no longer inverted. It did not predict the recession the inverted yield curve had been in place for quite a while. And you can see the movement in the 2-year treasury, and that's really the market not anticipating that cut from the Fed, which you would have seen the 3-month treasury fall to take out the inversion. Before I turn it over to David to go through compliance and performance, any questions? Yes, sir.
Quick question on 14. Just given that, all the talk around tech and tech stocks and it's driving the market, have you guys ever looked at this sort of S&P earnings excluding tech and what multiples look like excluding tech? I'm just wondering if the market sort of overvalued if we stripped out of tech. How do we feel about the portfolio just given the disproportionate?
That's a major factor because these tech companies are a big part of the indexes. And yeah, if you exclude those companies, the valuations of the markets look quite a bit better. One may argue that the valuation of those stocks are warranted because they're also growing much quicker than these other companies. One of the overall kind of longer term thesis that our team has is it's going to be outside of tech, the impact of AI in terms of better margins, more profitability for areas, across many sectors, and also even outside of the US where we think the average company is much less profitable, the impact on AI could be more impactful there. But yeah, you're exactly right.
So follow-up question, which we'll probably deal with later on the slides. Do we have the right type of managers to deliver on those results, given some of the underperformance of our investment managers and some of our individuals? So we'll address that, but that's where the context of my question is some of the underperformance in some of these managers, is it over-indexed to tech flex? I'm just trying to make sure they're the right people if we're trying to play into that X-tech value growth, whatever it is, that we have the managers that can deliver on.
Yeah, we think so. David will get into that here in a little bit, but we're always going to be looking to position the portfolio better. There is a lot of passive management in the portfolio, which has been a good place to be. We still think that markets are efficient and difficult in a lot of spaces for active management. So we think there's a balance to strike there, but we'll come back to that. Thank you.
So just moving on to the next slide, please, or next 2 slides. We're going to cover I'll cover the investment policy compliance as well as give an update on performance. So if you see here on slide 10, this provides, every quarter we look at this to make sure that the portfolio is in compliance and with the Ohio Revised Code and the investment policy statement. And then you can see here, we're across the board in compliance for the portfolio. Slide 13, please. Thank you. So this is the total system snapshot at the end of the quarter. And you can see here that if you look at the top right, actually in the right column there, you can see the total cash and unrestricted total pool between the system and Select Insurance of 714 million. That is up significantly from last quarter. It was standing at about 672 million. We had if you look at the system cash balance of 153 million, that was increased by, it changed about 57 million there from a large receivable at the end of the end of the quarter there. So that would have
been the half.
That was the HAP. Yep, the HAP coming through, and you can see that cash balance increase there. Overall, as Matt or Adam alluded to, in the quarter, and I'll get into the market value attribution change, but you did see system investments in the quarter had negative returns, and I'll go through that in a little bit more detail here in a second. Slide 14, please. This gives you the update on performance, the market value change. And if you look at the last column there is the first quarter performance. The total combined system was down slightly, 1.1%. You can see between the non-reserve long-term pool, which holds your equity investments, was down 3.6% as we had that market drawdown in March. You can see the total domestic equities versus international. So international equities started off pretty strong for the first 2 months of the quarter. And then you saw that sharp pullback in March and underperformed domestic equities during March, but you can see slightly outperformed during the quarter. A significant portion of the portfolio is invested in short-term fixed income and cash, which helped during that period of volatility and drawdown in markets. You can see the non-reserve short-term pool was actually up slightly positive in a first quarter where most investments were negative. So that was contributing nicely overall to the portfolio returns. Slide 15, please. This is the attribution of market value change for the system portfolio. You can see the breakdown between reserve and non-reserve pools. If you look at the bottom of this page, we'll show you the first quarter of 2026 change. You can see net cash flows out of for the system of around 7 million. If you take a look at the net investment change, down about 4 million to ending balance of 422 million. If you go back the previous 3 years, markets have been really strong. You can see the net investment change across the board over this 3 calendar years is about 40 million for each year. You take a look at the captive as well. The attribution of market value change here, you can see net investment change for the captive down about 1.6 million. And that
Next
doesn't.
slide, please.
Thank you for the next slide. And that does exclude the operating cash of 16 million on that ending balance. Next slide, please. So this is an updated snapshot of the portfolio as of 4/14. Some of the things here in the second quarter, just as we, in April, you could see equity markets rebounded. You have the ceasefire announcement. So as Adam mentioned, almost back to all-time highs across domestic markets and even in an international space. I want to give you an update on some of the numbers here. As of yesterday, I took a look. As of yesterday, the system is actually up about 12 million. So down about 4 million in the first quarter, has recovered really nicely so far in April. So I want to pause there, see if there's any questions. I don't know if you want to get into any detail across the board and answering your question, Artis.
Yeah,
So which one, is Harbor Capital the only active manager of the large cap equity? I'm just looking at domestic equity.
Harbor and DFA is an active strategy. DFA is sort of a hybrid. It's a quant group, but it's active. It leans value. So last fall, we took some gains from the portfolio just based on the proportions of where we started. So when we took those gains, I think we were chipping away at more of the growth oriented strategies. To your comments earlier, just because the valuations are better in other parts of the market, and we think there is some fragileness in that tech trade right now.
And when the market's been going down, it's been the growth stocks have gone down more.
Right.
But they've been coming back more too when the market comes back.
Yeah, kind of cuts both ways. So we're comfortable with all of these positions. We from time to time do make some adjustments. I will say that Vanguard FTSE Social Index, which is screening out some things, does lean slightly more tech than the S&P 500 because it avoids energy companies is one of the areas that they screen out. But we were chipping away at that position a little bit, and also that Harbor Capital appreciation.
That's where I was going. You see the same thing I'm seeing. Is there?
Yeah.
Over the life they've done well. Is there anything to be? I'm just looking at the 1-2 year return versus benchmark. Is it a benchmark issue or is it a performance issue?
It's active management has struggled. I mean, if you beating the market has been really challenging, especially when it's sort of whipsawing and you've got some of these big tech companies that are enormous weights. So I think it kind of furthers our comfort with the larger
depending what index you're looking at.
index
The
position.
Dow Jones.
Exactly. So it could
Right.
be.
Big difference between this.
Right. We think they're picking the kind of growth stocks that we want them to, but we've seen just kind of general inconsistency with a lot of active.
That's helpful.
Strategies.
That's what I thought. Okay, just wanted some color. Thank you. Appreciate it.
Of course. We got one last section to go through. So starting on slide 19, once a year, we just want to look at the investments strategically. There's lots of ways to think about risk from the organization level to the strategic makeup of the portfolio to more the statistical nature of the investment. So there's a lot to take into account. On the following page, every year our research team reassesses what we expect to earn in various parts of the global markets and different types of strategies over the next 10 years. So this isn't a 2026 forecast, it's on average per year over the next 10 years. And what's happened is the last 3 years, the market has done very well. The S&P is up 25%, 26%, 17%. It's grown quicker than earnings. So in other words, we've stolen a little bit from the future, and that's lowered some of our future growth expectations. And that's the case on the equity side. And even as interest rates have settled down a little bit, that's also the case on the fixed income and cash side. So with these expectations in mind, if you go to slide 21, we're applying those growth forecasts to the various segments of the portfolio. So the reserve pool, non-reserve short-term forecasting, basically a cash-like return, 3.5% over the next 10 years. Given the Fed is not likely to cut rates, the cash yield, albeit not 5%, still relatively attractive of where we've been the last decade at about 3.5%. The non-reserve long-term pool, we're forecasting about a 6% rate of return, with a confidence interval between 2.5% and 9.5%. And then total system assets, about a 4.5% rate of return. I know no one's going to get up and start clapping over these growth expectations, but you got to keep in some context of the growth that you've experienced and kind of blending the past and the future together. We're also showing you the mix of the captive, which is about 50% stocks, 50% bonds, about a 6% return expectation there, which does roll up into the financials of the system. With that in mind, another way to think about risk in the portfolio is we've got this sensitivity analysis on slide 22. So we're interested in equity market sensitivity and also sensitivity to interest rate changes. So these are 1-year snapshots, and it's a kind of a what if analysis. What if equity markets are down 25%? And that's the example that we're giving here. So based on the overall makeup of the investments, if the equity markets were down 25%, we'd expect the system to be down around 4%, which would be roughly an $18 million loss. That's a negative scenario, but you can play it out in either direction. And this is pointing to the somewhat conservative nature of the overall investment portfolio. Any questions on any of that?
Questions? No questions?
And just one more schedule, sorry. The last page is the annual review of the investment policy. So everyone should have a copy of that. And it can be sent to you, but we've taken the policy and we've run it through this checklist, and we wanna just kind of remind the group of some of the key items. The non-reserve long-term pool has a longer-term investment horizon, as you would expect. That's detailed. The reserve pool, you're focusing on preserving capital, and this is where your cash and short-term fixed income is allocated. The overall investments need to maintain liquidity. It's noted here that we're evaluating costs on an ongoing basis. The overall fee structure is very low, and we'll take a look at that at the next meeting. The committee is required to meet quarterly per Ohio Revised Code, so you're doing that. Retaining an investment advisor. David talked about the $300 minimum balance in cash. And then also the minimum exposure to fixed income across the whole system is at least 60%. And then lastly, noting in the policy that you're in accordance with Ohio Revised Code 33-906 and 061.
I just remind you that we're two policies. We have the Ohio, and then we have the county caps with how much we invest in international, and then private equity and things like that. So that's why you don't see that. If there's anything else, any final questions? If there are none, thank you so much, Adam and David. So we're going to move on.
Thank you.
Thank you, guys.
So we're gonna to Mr. Woods, Mr. Mooney, and Ms. Morales, and they're gonna give us overview of March 2026 financial report. Remind you, we're still in public session, and we were going to, for proprietary questions, you might want to save those till we get to executive session. Thank you.
Right, while we're pulling up the slide deck, I will let the committee know. So the finance team has been hard at work over the past few months, really modifying the format and content of what is in this finance committee deck. Our goal was to really improve, clarity, make the information more concise, more easily able to be interpreted, and to deliver really improved KPIs and more detail in areas that we feel are key for the committee's awareness. So having laid that groundwork, Patrick and I are going to talk through the changes as we get to each slide, but we are excited to present this new format to you, and I'm happy to take any feedback.
Thanks, Christina. Yeah, can we go to the next slide, please? So we'll dive right in here. So this first slide is just a snapshot financial summary of our performance for the third quarter. We included March there because March is a little bit different than January and February. But this is really a condensed version of our income statement. We'll get into more of the detailed income statement later in the presentation. But we just wanted to go through some high level details here. We also included the stats on the bottom. We felt like this would be beneficial as we talk through some of this variability within the patient revenue and how it relates to the stats, instead of having to go all the way to the back end of the presentation to look at the stats. So I'll just start at the top. Looking at net patient revenue, we came in at $369 million for the quarter. And I'm going on the right side here, which was exceeded prior year by $20.9 million, which trails budget by $15.9 million. The real difference in the variance why we were so favorable to last year is that we are starting to record the HAP 2.0 money. Obviously, we haven't received that money, but we're accruing it month over month, and we didn't get that large payment until December last year. And when we're looking at it to budget, we were under by 15.9. It was really driven. If you look at the bottom on outpatient visits and emergency room visits, they really, January and February are really tough months for us from a volume perspective. We actually caught up. If you look in the March line item on our outpatient visits, we're over 7,000 to budget. But it wasn't enough to kind of push us over that threshold. A lot of that, we had a lot of bad weather days in January that affected us. But really, that's a true driver. I mean, everything else was a little bit, kind of right on par with the inpatient surgeries and outpatient surgeries, but the real drivers were the outpatient visits and the emergency room visits. Other revenue was favorable by 5.4, another stellar quarter for our pharmacy revenue. Continues to beat its expectations. It's evidenced with the prescription filled on the bottom. We beat our budgeted scripts by 28,000 and 25,000 higher than previous year. So really excellent growth there. So our total operating revenue was 528, which was $10 million off target and $25 million higher than last year. Moving on to the operating expenses, salaries and benefits was pretty consistent with budget and prior year. If you look down at the FTEs at the bottom, we actually were very favorable in the number of employees we had at 377 to budget and 369 to actuals. What we did have was we had a across the board pay increase that occurred in February, which wasn't budgeted until June, which really kind of cuts into that favorability. We also had some ARC incentives that we started accruing for in anticipation of what we will have to pay in the following year. We don't want to get to a position where we're at the end of the year, we had to play catch up with our accruals. And there was also some contracted labor that contributed to that as well. Department expenses was very favorable to budget. Really, this is kind of driven by really kind of controlling that spend as we finished off last year and rolling into the first quarter, same controlled spend. There are some projects that were earmarked that we included in the budget that we didn't know the exact timing of it, so it's more or less straight line throughout the whole budget. We still expect some of those expenses to occur, it's just they didn't occur in the first quarter. So where we had some favorability this quarter, we could potentially not have that same favorability on the back half of the year. And then if you're looking at depreciation interest expense, this is really the OPHC. We anticipated to get the certificate of occupancy in February in the budget, so we started amortizing that building. That didn't occur when we expected. Now we're expecting to receive that in May, at which time we'll put the building and all the equipment and services, and then it should straighten itself out within the budget. So overall, our total operating expense was very favorable to budget at 13 million. Our operating loss for the quarter was 15 million, which is $2.6 million better than budget and $11 million better than prior year. Again, a lot of that loss was really attributed to January and February slow start, which are always slow months for us. But we did, if you look at the month of March, we were right at break even. So that's really promising news moving forward as we go through the remainder of the year.
The non-operating revenue line is what Clearstead was talking about. We ended March kind of tough on the investment side of the world.
I don't see EBITDA in there.
Oh, well, since you asked. Our EBITDA for the quarter was 26.4 million, John, and that was pretty right on budget.
Okay, next slide, please. Okay, so as Christina mentioned, we're gonna kind of point out some KPIs that we felt was relevant to our business operations. I don't think we really stressed this enough moving and historically, so we really wanted to bring this to the board's attention. So I'll just walk you through everything. The operating income loss, we just spoke about, but the operating margin, see better than budget, better than prior year, for March and for the year to date for the quarter. And then the next two statistic metrics are inpatient gross revenue, which we base off of a calendar day, where outpatient gross revenue, we base on the work day because we're out going the full 7 days. And if you're looking at year to date over here, I mean, our inpatient gross revenue, it's a little off, a little better than last year, but a little off on the budget. But the real driver here is the outpatient gross revenue during the workday. I mean, you see year to date, we're almost $1,000 off per day, really driven by those slow volumes in January and February. The next statistic is the MPR as a percent of gross revenue. This is really our yield, what we're actually expecting to collect off our gross revenue after you factor in contractuals, bad debt allowance, charity care, supplemental payments. Christina's gonna go, I mean, it's relatively flat for the budget and a little less than last year. But Christina's gonna go a lot more in depth in that in a later slide. The two next ones, the supplies, actually the next three are really are measures of how efficiently we're utilizing our supplies and our labor based off of our operating revenue numbers. So supplies as a percentage of operating revenue is pretty flat across the board. Not a lot of significant change there. Labor as a percentage of operating revenue was a little higher to budget, but better than prior year. And then operating revenue per FTE is actually significantly better than last year and to budget. This is really due to the reduction in the FTEs than what was in the budget and what we incurred last year. And then our case mix index is below there, which is a little off from target in prior year, just due to some less acuity within our caseloads. Next slide, please. So we felt like it would be a good thing to just kind of show for some of those KPIs to show the 13-month rolling trend to see how we are performing and how we're trending throughout the year. You know, if we're looking at inpatient and outpatient gross revenue, you know, it seems like we always kind of run this trend where we start off pretty bad and then we roll up in the third quarter, and we have in 2025, as everyone's aware, we had a really, really strong, third quarter and beginning of fourth quarter last year. And then it kind of tapers off in December. We struggle in January and February, and then we jump back up in March. It's a lot more evident within the outpatient visits as it is in the inpatient. And then with the supplies as a percentage of operating revenue to labor as well. I mean, this is relatively flat, but you see the significant drop in December, and that was when we recorded the revenue for the HAB 2.0, which is really kind of distorting this view. But if we back that out, it would flatline a lot more than what it is. Next slide, please. Again, this is kind of another way to look at the trends that we're seeing. Inpatient and surgical volumes kind of ebb and flow. Lots, again, same story as the last slide. A lot higher in July, August, September, October. Then we drop off a little bit in November, December, and then drop off in January and February too. Pop back up in March. Same with visits. These are outpatient visits here. And you can see that we had a really bad November. Some of these, January was a very slow month with outpatient visits. And then the fourth one is our prescription filled and we also included the capture rate. So you can see it as over time, our prescription fills, which directly correlates to pharmacy revenue generated, it's in line with our capture rate as how much of that business of the patients that we're seeing at Metro Health So we're almost 3 percentage points better than last year at this point. And also what you can see here is in the November, how we're obviously capture rate's not the whole story, but the November 2025, it's directly correlated to the reduction in outpatient visits in November 2025, right? We're not seeing as many folks where it doesn't turn into pharmacy revenue for us. So I think this is but overall, we continue to see that upward trend in the prescriptions filled with a few outliers driven mostly by outpatient visit volumes. Next slide, please.
All right, so this slide compares our quarter, this is on gross charges. It compares our payer mix for the first quarter compared to all of 2025. So like at first glance, the schedule might look like there isn't a lot of movement, but what I really want to highlight is that very slight incremental changes in payer mix can have a very significant impact on our financials. So if we look at 2025, our self-pay, which is that pink wedge here, is 6.6%. The first quarter in 2026, we're seeing 7%. That 0.4% in payer mix change equates to about $2 million in bottom line impact. So again, very little movement can cause big ripple effects when it comes to our ability to collect on our patient revenue. The other one that I'll call out is this green wedge, which is commercial. 29.9% last year has dropped almost a full percentage point. When we drill down and really double click on that, we are seeing a much lower volume of patients who are covered through the health exchange this year than prior year. And so on January 1st, 2026, that enhanced subsidy really dropped off. And so premiums are higher for folks on the health exchange. Some of the maximum out-of-pocket caps were raised. And so we're really seeing less coverage through the health exchange. And therefore, some of those patients are really falling into these sort of self-pay uncompensated buckets. Next slide, please. So this is the more traditional income statement that I think the committee is used to seeing. I'm not going to spend a ton of time here because Patrick did a great job giving the overview on the first slide. One thing I will highlight is we did add a subtotal here in operating expenses for total labor expense. It's a great way to sort of see of our expenses, what portion of it is labor. Contract labor does live in that salaries and wages line. So Patrick was speaking earlier about FTEs to, salaries and wages expense. That's another factor to consider is there's contract labor that lives in the salaries and wages lines that are not necessarily folks that are in our employ. I'm going to transition to the next slide because I think of all the slides that we revamped, this is my prediction on the crowd favorite today, which is our operating revenue detail. So on that income statement that we just looked at, there's really only a few lines that are kind of summarized that are in our operating revenue section. This slide really takes those lines and explodes them into the level of detail at a program level. So you can really see what's going on, underneath our operating revenue. One item to note before we sort of move through talking through the lines on this chart, most of the assessments that we pay into our supplemental revenue programs, we put the money up and we receive the funding back. And so the assessment is sort of netted within the revenue lines, with the exception of franchise fee expense. So that program and that assessment really lives separately. And so it's recorded in operating expenses on our income statement. In order to get a complete picture of operating revenue, we actually pulled that franchise fee expense out of expenses and put it up in this revenue schedule. It's the asterisk item right underneath the HAP line. So the adjusted or the patient revenue numbers and the operating revenue numbers on here are adjusted by that expense. And I think it gives a nice representation of, the total cost and value of these programs. So I'm just going to walk down the slide so everyone can kind of get a feel for what these different lines are. So inpatient and outpatient revenue right at the top, these are gross charges. So bills out the door, this is the gross value of our charges. The next three lines, contractuals, charity care, and bad debt, those are really the adjustments to charges that bring us down to what we collect on the claims that we bill. And so you can see netting that gross patient revenue, contractuals, charity, and bad debt. As Patrick indicated, we are below budget due to lower volumes. We are also below prior year. But as we move down, this next section our HCAP, which we have on here is Dish Care Assurance, our HAP program, CSIP, GME Medicare. These are the supplementals that support some of those patient revenue dollars and specifically help to bring things like Medicaid rate up to the average commercial rate. So you'll see here, the one thing to highlight in the supplementals, the enhanced HAP, the 2.0, $31 million over prior year. So that's really a main driver of why our operating revenue is much more favorable this quarter in 2026 compared to the same quarter last year. Moving down to the sort of the other revenue section, we have many accounts that go through other revenue, but we really pulled out the major ones here for the committee's awareness. So contract income, that is when Metro Health has an agreement with a third-party vendor and we provide services. So it's anything from our providing services at county corrections to medical directorships. We have various types of contracts where we provide services in and around the community. And so that's the contract income line here. Grant revenue and pharmacy revenue, fairly self-explanatory. Value-based revenue. So this is really the value of the programs that we have that have quality indicators or measurements for how the system performs in certain payer contracts. So this is, and that's also our ACO. You'll hear us talk about our ACO and the value that that brings. The savings.
ACO.
Yeah, that the shared savings component of that gets recorded in this line. And
What does ACO stand for?
Accountable Care Organization, Collaborative Care Partners is the name of the entity we have here that holds our ACO program. The next line here, capitation income. So if I'll try to keep this brief if the committee's familiar, but I'll just give a little bit of an overview. So through that Collaborative Care Partners, our ACO, John, we have patients who are aligned to the program, right? They're really attributed to our ACO. And instead of getting paid every time they come in and we provide a service and we just get paid a fee for service amount, we really get paid a monthly amount to handle the totality of their care. So since it's not a direct relationship of services provided to revenue that comes in the door, we get like a flat amount every month to care for them. It's called capitation income and we recognize it here in other revenue. And then that last line, other revenue, that's really a smattering of sort of other ancillary things, cafeteria, parking, things like that, that support our operations, but are not main operating income drivers. The biggest thing to point out outside of our discussion we had on patient revenue is really, Patrick alluded to the pharmacy revenue here, $8.5 million over prior year, 25,000 scripts over prior year, continue to see a lot of success there.
Last time we did go through all those, HAP and HCAP. Are there any questions on any of that? That we're gonna show these on a monthly, or I'm sorry, quarterly that we can.
We're gonna ask, so we have another finance committee meeting in May. And we talked last time, because Kinsey, I know everyone was very interested in Kinsey's presentation, and we had a pretty full agenda last time, so we kind of ran out of time, so we were gonna ask Kinsey to come back. He couldn't be here today. But I think what we should have Kinsey part 2 at next month's finance committee. And so where we ended was we had gone through all the programs, but Kinsey was going to go through the dollar amounts and kind of more specifically how those mechanisms work. So he'll be on the agenda for next month.
Next slide, please. Bounce back. Okay, so I'm just gonna go through the balance sheet really quick. Not a whole lot of change in our balance sheet. There were a few items that I wanted to point out. There was a significant decrease in total current assets. This was driven because we had the receivable for the HAP 2.0 that we actually collected the funding in the first quarter. Looking down at the non-current assets, you could see our investments dropped off. That was really driven by the poor market performance of our investments that Claire just mentioned. And then restricted assets decreased as well. We made our debt service payments in February for the bond payments. And basically what we do is we fund that every single month and then we pay it annually once. So we're basically building up that asset, and then it moves into restricted, and then release it. And the corresponding offset is in long-term debt on the long-term liabilities. And then on the liabilities, really the only thing to point out is in other current liabilities there. You see there's about a $30 million decrease. We did pay off the $24.8 million line of credit that we had with Key Bank once we received those HAP 2.0 funds, with the intent of having it used for a true line of credit. Next slide, please. I didn't really specifically point out cash because this was the next slide. So as you can see, our cash balance really increased from last year, driven by that HAP 2.0 payment. And we're at our highest level since 2022. You know, obviously we collected $108 million with the HAP payment. And so there's always kind of this discrepancy, like why did it only go up $57 million? Well, our investment balance dropped a little bit with the poor performance. We made that line of credit payoff for $24.8 million. We had to prepay our franchise fees associated with the HAP program that was $24 million. And then there was also physician incentives for production and non-production. With the non-production, we only pay annually. So that really ate into the total by a tune of about, over $50 million, right? So again, it's really good that we collected that $108 million, but it really goes quickly. But in a very good, much better cash position than we have been in the past 5 years.
All right, so next slide. So that parlays nicely here into looking at our covenants. So the improvement in cash really led to an improvement here in our days cash on hand. We really rebounded back to just above our 2024 levels, 126 days cash on hand, which is fabulous. And when we went through at the last committee meeting and really talked about that 13-week cash forecasting process that we have, what we talked about was it takes about 5 to 6 million in cash to run our operations every single day. So an improvement here of 7 days, it might only seem like 7 days, but really this is a very significant improvement in cash. And so we're very proud of the movement here. Slight increase in our debt service coverage ratio from 3.55 to 3.73. And as Patrick mentioned, we did pay off our line of credit. So that sort of lowers our annual debt service amount and improves our metrics here. Next slide. I'm not going to spend a ton of time here. We put this in the package quarterly. It's a really nice overview just comparing we measure this on a trailing 12-month basis. It just compares Metro Health's metrics to the benchmark medians for our rating agencies, comparing us to other BBB- ratings. You'll see very green, which is positive. The few items here that are in red are really some of the ratios around debt and capital. And as the committee knows, we have the Series 2017 bonds, which makes us look, we are highly leveraged. And so that's where we tend to see a little bit below benchmark, but really operating very well. Next slide. And this is our last slide, our capital budget summary. We did make a slight modification to the lower table here so that you can see how our capital is moving by area that we commit capital. So at a quarter in, we expect to be about a quarter through our capital, and that's right about where we're at. We are moving forward with some of our major projects like the ED refresh and some of our IT projects, Epic upgrades, things like that. So nothing too exciting here other than to say we're right where we expect to be.
And recall last month, when we did the budget, we had another 45 million in for 2026, but last month, we got approval from the committee to do another 20, which we really needed. So it's good. So you start to see how that's being allocated here. So it's 65 instead of 45.
Yeah, that's a great point. And if you look at the 2025 line here on the top, you'll actually see we've got a bit of a balance left from prior year. Obviously, the first quarter in prior year was a struggle. We had to make some very difficult decisions that paused some of our capital efforts. When we budget our annual capital amount. It's really a commitment budget. So once the year's over and we move on to the next year, you know, we're not going backwards and using up unused dollars. So that improvement in the budget this year also sort of helped to get some of our projects back on track and give us a little bit additional funding for this year.
Great, thank you.
Thank you.
Okay, any general questions before we go into executive session? No, with that. And we're going to move into executive session to discuss hospital trade secrets as defined by ORC 1333.61. Do I have a motion to recess into executive session to discuss these matters?
So moved.
Second,
Second.
all those in favor?
Yes.
Oh, do I get?
Mr. Boss, we have to take a roll call.
Sorry. Artis, yes.
Yes.
Ron? Okay. Yes, me, Dr. Walker.
Yes.
Now I'm gonna ask the public to step out. We are now in executive session.
1 second.
to move around.
Okay.
Thank you. The session is over. Thank you.
Okay, thank you.
Thank you, everybody.